Over to you.
Yeah, and additionally, just kind of hitting on that inflationary point, in some of their most recent statements, they have continued to keep a close eye on inflation. And at the time, they were talking about inflation continuing to run below 2%. And overall, the financial conditions we do know from the FOMC have remained accommodative to this point. So it would be interesting to see, to your point, Jill, how they change their tenor around this broader caution in inflation and the concern in inflation, I should say, most notably. But diving more in on these retail sales numbers, it comes in at a time where we also got the producer numbers that have risen as well. We'll get more into that right now as May retail sales data just hitting the wires a few minutes ago, showing a 1.3% decrease in May as it comes at an inflection point for the industry as changing trends and the pandemic have rattled the retail sector to its core. This all comes as the markets are awaiting news from today's Fed meeting, and that's kicking off today. We'll hear more from that tomorrow in a statement from Fed Chair Jerome Powell. But joining us now to discuss retail is retail expert Erin Sykes and chief economist for Nest Seekers International. Erin, your initial reaction to May's retail sales numbers?
So I'm not surprised that May sales numbers are down because we really only saw a bump in retail sales every time a stimulus check was released. So unfortunately, it seems like the strength of the consumer has been bolstered by the stimulus checks in a way that's not sustainable long term. We are definitely starting to see inflation, and of course the big question is whether it's transitory or not. However, people are not fully employed yet. We still have very high unemployment numbers, and even though they're spending their stimulus checks, there's not anything banked for the long term. So it's really just individual pops that we're seeing. So I think that it is a big question, and this should ring heavily on the Fed's mindset as they go into their meetings, because it doesn't say to me that we are as strong as we have been thinking that we are.
And so with the Fed, they've continued to remain accommodative to this point in time. Fed Chair Jerome Powell has really looked across the environment and continued to use this phrase moderating economic recovery. And so in this economic recovery right now, of course, the focus is on employment and how that employment will stimulate either wage growth that can then be stimulatory for any type of spending that may come from households as well. And so where do you expect the Fed to discuss some of this most recent data that's come out either on employment or on the retail side as well, and really evaluate what necessary steps they need to take either in an accelerated fashion or whether they just continue the course that they've already laid out?
Yeah, well, I think from all indicators, they're most likely going to continue the course. Do I think that that is necessarily the best course of action? No, I think that all of these new indicators that have come in should weigh heavily on their minds. However, I think that they have set a path and they will continue to move down that path. So the bigger question becomes, how do we as individuals and as companies moderate ourselves and account for the increasing inflation until we do see rates tickle up and also things level out in terms of pricing.
Producer prices also climbed 6.6% in May on an annual basis. That is, for a 12-month period, the largest on record. And so when we think about the producer prices and in tandem with the retail sales data and how retail sales fell 1.3% in May, correlate these between us or for us, because when we think about the producers and what they have to take on to make sure that a product even makes it out to the market, and if you see that in an environment where the consumers have less of a propensity to spend, as the data revealed in May, what does that signal for how producers are forecasting where the markets will actually receive their product, purchase their product, and how they are ultimately guiding for the rest of the year and their own performance from the producer side?
Sure. So this really goes into supply chain, right? So we have a shortage in our supply chain. We can't handle the amount of autos that people, we have the demand for. We can't produce enough food. We can't produce enough building materials. We see such an increase in pricing for new construction that most millennial buyers at this point are even priced out of the real estate market, even though that is such a boom right now. So it really goes to show that we haven't seen the worst of it yet. I think that we're in for a rude awakening because of the increase in prices to manufacture, to build, gasoline, auto, everything. I think that it just hasn't hit yet.
So the supply chain also in focus in pretty much every part of the retail equation, but specifically as it impacts consumers on a week in, week out basis. When you think about the food and beverage sector, people going to the grocery store and seeing supply chain issues impact how much they are paying for the average item that they would just like to put in the fridge at the end of the day. How much longer can the consumer navigate through that and some of the price increases that they're seeing there, given the supply chain disruption that we're seeing more broadly?
I think that's a question of employment. So if we go back to being a low unemployment nation, we will definitely see things kind of flatten out. However, if we continue to rely on the government for stimulus checks and people stay unemployed, frankly, unnecessarily, then we're going to see a continued impact of these price increases because people, $1,000 every 3 months is not going to support an individual or their family. So we really have to get back to a fully employed nation.
Got you. And then with regard to the different categories that we've continued to watch, you and I have talked about apparel very often in the past as well. And so for the supply chain in apparel right now and how those companies are continuing to try and sell into a consumer that is saying, hey, you know what, we're trying to get back out there. We are either going to in-person events once again, or we're making our way back to the office. What notably have you seen within some of those trends, more broadly perhaps, in the apparel, the footwear categories, as people are making those lifestyle shifts as we kind of return to pre-pandemic norms?
I think people are looking forward to going out and physically shopping in stores again. Walking around Soho over the weekend, there were lines out the door in every major apparel store. That said, it's also because of the limited capacity, so it's hard to gauge during 2019 if there would have been higher or lower foot traffic. But there are definitely people out there shopping. How much they're spending, what their per order is, if it's sustainable, that's the bigger question. But people are looking forward to getting back out there. And I think in terms of the distribution between people spending in retail, in terms of clothing and shoes versus getting back out there in restaurants, we're seeing the restaurant move first, and then as long as that evolves in a positive path, we'll see the uptick in clothing, apparel, shoes, that type of thing to support a lifestyle that allows people to go out. That said, also tied into, is everybody working? And can they afford to go out to those stores more than just once? Is it going to be a continued momentum?
Sure. Retail expert Erin Sykes, thanks so much for giving us the breakdown, your perspective and insights here after the U.S. retail sales have slowed during the month of May. We're going to see how the FOMC continues to evaluate this. Everyone coming up right after the Keystone Pipeline project was shuttered. Another pipeline project is approved. There's more when Wake Up with Cheddar returns after the break.